Our next guest says gridlock in DC is normally good for the market, but he says the next 2 years will be far uglier than most, and that means gridlock's not that good. Dennis Gartman, editor and publisher of the Gartman Letter, joins us now. Dennis, make your case that because the next 2 years will indeed be thoroughly ugly, it's not good for the market.
Well, it really is not good. In the past, gridlock, I was one of the few people 15 years ago who argued in favor of gridlock because I know that gridlocked Congresses and presidents could do no damage to me, and I thought that was always beneficial. That would be conservative government that got very little done, and more often than not, when they do things wrong. So I'd been a proponent of gridlock and applauded it. But this time, given the anger, the dissension, the determination on both sides to demonize the other, I'm afraid that gridlock is going to be uncommonly and unprecedentedly ugly. And for the first time, I actually would say, you know what, gridlock ain't that good.
Does ugliness in our public discourse translate into a cap on the stock market?
Well, I think there are other things that are putting a cap on the stock market. I'm really quite bearish of stocks, and after the rally that we've had, which for a technician's perspective just merely got back 50% of the break that we'd gone through, and the volume that was coming in on the downside was demonstrably stronger than the volume that came in on the upside, which tends to take you bearishly. The problem that I think the stock market has to deal with is the fact that the fuel that had sponsored both the strong stock market and the strong economy, growing monetary policy, advances in the adjusted monetary base, that fuel has been taken away. We have not had that sort of fuel to inspire both economic growth and strong stocks since late 15. So I think the fuel has been taken away. The foot is off the monetary gas, and that, I think, will be the precursor for weaker stock prices. Do I think it's going to be demonstrably weaker? No, but marginally so.
Dennis, I don't want to get technical, and I rarely try to discuss the Federal Reserve on this program, but I'm going to bring it up for a second. Am I right in saying that they are taking money off the table as they liquidate? Well, I'm not quite sure of the correct expression here.
Yes.
But they've got trillions of dollars on the books. As they liquidate that, as they get it down, does that take money out of the economy?
Yes, it does. Actually, I was talking about the adjusted monetary base, which is really ostensibly the Fed's holdings of Treasury securities. The Fed creates money and puts it into the economy by buying securities from the Treasury and writing a check upon itself. I know that sounds terrible, but that's what happens. And you need to have money growing just to accommodate growth in the economy and population. But since 2015, after a huge expansion in the adjusted monetary base, the Fed has allowed those Treasury securities to roll off. They haven't liquidated them. They've simply allowed them to roll off, and that has really taken money out of the system. As I said, the foot is off the gas as far as the supply of reserves to the system, and therein lies the problem.
So you don't think it's going to be a big sell-off, but you don't think we're going to go much higher in the next year or so or whatever, right?
I think a year from now we could be 5 to 10% lower than where we are, and the odds of us being 1 to 2% higher, I think, are limited.
Okay. What's the date today? It's November the 8th. Dennis Gartman, November the 8th, 11:04 Eastern Time, says we might be 5 to 10% lower in 1 year's time. The chances of 1 or 2% higher, slim and none. Can I sum it up like that?
Yeah, you can fill it up like that, but that will come back to haunt me, no question.
Of course it will, Dennis. What do you think videotape's for heaven's sake? Dennis,
to haunt me.
But you're all right, and we appreciate you being with us, Dennis. Thanks a lot, sir.